I want to start just generally about the collateralized loan obligation landscape and the view into 2020, because we've seen kind of a soft year in terms of issuance as well as performance. What do you see for 2020?
Yeah, interestingly, I think we're going to have a little bit better start to 2020 than we thought ending in 2019. CLOs were hampered, especially on the broadly syndicated side, with CCC buckets being full and B3s being scarce in terms of not wanting to go CCC. And so what's happening now is they've been conserving cash over the last few months. And I think going to 2020, it looks like, based on some of the secondary price movements in leveraged loans, that there's going to be some room for them to start investing again. Not going to be a lot, but I think you'll see a firmer tone in the overall leverage market as far as the broadly syndicated market goes.
Okay, so this is not necessarily with respect to investors putting money into new CLOs, but existing CLOs are collecting cash from the debt that they're selling or letting run off, correct?
That's correct.
What about investor demand more generally for leveraged loans?
So I think as the market continues to firm on prices, which affects the assets that the CLOs are holding, I think that's going to be a benefit. One of the things that CLO formation depends a lot on is where AAA pricing, which is the liability side of the equation, goes. That's been on the higher side this year. It's hard to see where that's going to go next year, but I think that overall deals are getting done. We've at Churchill have done middle market CLOs. So I think there will still be room for CLO formation, which is a positive thing.
All right, you said when we were talking before this that you think that first quarter is going to be really active, in particular with sponsors bringing deals to market.
Yeah.
Why?
Well, I thought we would coast into the end of the year at Churchill and kind of have a nice holiday season, spend time with our families. Well, it's turned out that our deal flow has never been higher in the last couple weeks. And I think in part, talking to sponsors, there's a little nervousness about next year, particularly in the second half relative to kind of political risk and concerns. And so my sense is they're trying to get a jump on 2020. So the pipeline that we're seeing now is really geared to sort of January and February closings, which means I think they want to make up in time for what they think may be a bit of a slower second half or less certain. Anyway.
And when you say pipeline, you're talking about financings for LBOs or other types of deals?
All kinds of private equity-backed deals. So it's refinancings, it's new platforms, it's add-ons, and we're seeing really the full range of those deals.
How are the structures, do you think, of those deals? I mean, are investors pushing back and showing discretion, or are you seeing things kind of getting a little frothy?
Yeah, we're actually pushing back on behalf of our investors because things are getting frothy. Our hit rate is less than 10% of the deals that we look at for that very reason. We're trying to be picky, and we actually are succeeding. So the leverage in the deals that we've been doing has been pretty consistent over the last several years. But yeah, we're on the alert for deals that are getting levered more than they should be, particularly some of the cyclicals, which still is something to be careful about.
One theme that you and I have talked about, and a number of others as well, has been that direct lenders have been taking over a greater proportion of the business once dominated by the leveraged lending area.
Right,
that basically syndicated loans are getting pushed aside. Do you see that sort of accelerating as a trend in 2020?
Direct lenders are continuing to raise capital, and they're doing larger and larger deals, as you've commented really brilliantly on this show. And I think the thing that to watch out for is that as the direct lenders like ourselves get more capacity, the deal size is going to grow, and that's going to cut more and more into the syndicated product. It's also going to be interesting the second half of next year to see where the volatility goes relative to political risk, and if you start seeing more volatility and uncertainty as to where the overall public markets and liquid markets go, you're going to see the sponsors kind of going flight to safety, which in our case is companies that can get their deals done with a certainty of execution.